Again, thank you all for joining us today. I have the honor of introducing 4 individuals to you who I've gotten to know in various roles and capacities over the past 15 years in the resources sector. These are 4 professional analysts and investors who have a lot of global experience and Australian experience. And while gold is certainly a very significant component of their experience and expertise, they also have much broader backgrounds in metals and various different markets. So these will be very, very valuable insights that they can draw upon when we think about what are risks and opportunities, what projects are of interest, what are dangers, what are the red flags, what do we look for. So just by way of quick introductions, for those of you who have not heard me speak already, I'm Alex Scanlon. I'm an economist by background, a managing director of Park Capital and Gokta Management, and the managing director of Barton Gold, which is one of our companies that we took public in 2021. And going down the panel, I'll start with Brian. So Brian is a risk and financial markets analyst. He is the founding director of the Australian Gold Fund. He is the precious metals editor of Fat Tail Investment Research and the publisher of the Australian Gold Report. Andrew McLeod is actually originally a physicist by education, so definitively the smartest person on the stage, and is an investment analyst in practice. So he's now the senior analyst with a private family investment group called Ilwella. Richard Crookes is a geologist with a very diverse background, from exploration to operations, debt financing, and principal investments. He is the managing partner of private equity fund Lionhead Resources and also the chairman of Brightstar Resources, another gold developer on the ASX. And last but not least, Rob Curtis, another geologist who's found his way through a rather illustrious business development and financial career. Very diverse global experience from Indonesia, India, Laos, North and South America, and of course Australia, and is now an investment director with EMR Capital, quite a large private equity investment group that many of you will be familiar with. So I'm quite conscious of my own slightly circuitous and unusual path to my current role as director of a public company. So I might ask each of our panelists to give a little bit more of their background and maybe touch upon some of the gold-specific highlights, since that's one of the themes of the conference. So maybe we'll start with Brian and work down the panel.
So my background was actually more of an outsider. I didn't work in the finance industry. I was actually an academic. And how did I come to know about gold? It was through my primary school friend who told me about what happened, like the truth behind how gold is you could say phony money took over fiat currency. And from there on, I investigated further and used my research skills from university in order to build my own systems in analyzing what's happening with the markets. And my focus is on gold mining stocks, which I'm writing newsletters for, and also investing with my own cash. I don't actually invest on other people's behalf simply because there's more stress losing my money than losing someone else's along the way.
Thanks, Brian. So my name's Andrew. As Alex mentioned, I started my life in the world of physics, but that was definitely not my calling. And I got into mining investment just by chance, really, through just getting into the financial markets. My first ever stock was a company called Bolnisi Gold. Some older folks would have remembered that one, and I got very lucky with that one, and I was hooked from then. But I just wanted to be an analyst and the best analyst I could, so I went back to uni and did another geology degree. But my focus is really on all of the resources, and gold obviously just falls within that sector.
Thanks, Andrew. Good morning, everyone. Nice to be here and talking about precious metals. Started my career in '87 as a geologist in a number of mining companies, gold projects, copper gold projects, and that was the first third of my career. And I guess on reflection, I think that sort of teaches you what sort of good looks like, good leadership in particular, good management teams. Then I was fortunate to move into a mining finance role with Macquarie for 12 years, deploying the bank's balance sheet into project finance and equity investments. So we were global business. I was based here in Sydney, but we financed projects, a lot of gold projects, single asset sponsor companies across the world. So that gave me, again, a good sort of exposure to different types of risk in gold company development. And then the last third of my career has been in private equity, private capital investing, and also moving into director roles on a few ASX companies. And as Alex said, come back to gold with Bright Star Resources just recently.
Thank you, Richard, and good morning, everybody. I think, Alex, between the two of us, we sponsored drinks last night, so I think that gives me carte blanche to say anything I like while I'm up here.
I think that's right, yeah.
So geologist by background, excuse me, born in the Victorian goldfields, so I think it was meant to be, really. There was no getting away from that. So, and then graduated in the mid-90s and with CRA, which became Rio Tinto, and that's back in the days when they actually did gold. And so was around in Southeast Asia when Bre-X and Busang was a thing, so that will immediately timestamp people that remember that, and certainly don't mention that to a Canadian still. And then joined a little company called Oxiana, which became Oz Minerals, and we financed a gold project in Laos on the Ho Chi Minh Trail when I think gold was $250 an ounce. So think about that. And then about 13 years ago, turned to the dark side of private equity, which I see one of my investment committee members in the audience. He will get both the truth and the humour in that. When we formed EMR Capital in September 2011. And so gold is, we are mining only, and gold is a large part of what we invest in. We're very commodity specific, really 4 commodities of choice, but gold and copper amongst those are really the 2 prime ones. So about 25, 30 years in the industry, and gold has been there from the start.
Thank you. Yeah, so, gold, precious metals, but, we'll focus on gold in terms of an easily identifiable topic, really being the topic of the day. What we see, I think we would all agree that we're here because we see that it is increasingly relevant, and it does appear to be increasingly valuable against a very complex and evolving backdrop of geopolitical, social, macroeconomic, and monetary factors. And as we stand here today, what we can see in the world around us is probably for the first time in a very, very long time, a coordinated and sustained push by BRICS and BRICS-associated countries in the so-called Global South against what has largely been, or is probably best described or fairly described as sort of the Western-led NATO US dollar hegemonic structure that has largely guided and shaped the world as we know it since the end of World War II. Much of what we've learned, in fact, everybody here who went to school was basically taught about the social and financial fabric of the world that was sort of defined by the US dollar and Western leadership. So, but for the first time, that's being challenged by people that are big enough to do it. They're working together. We're seeing shifts in these structures. And so for the first time, this actually appears to be a credible challenge. And that's the first time in 80 years that such a challenge has been mounted. We are also seeing, in parallel, a decline in political and social stability in a lot of these Western liberal democracies that have defined this structure. And so this is all happening at precisely the right time that might favor the fortunes of a challenge to that leadership role in the world. So a lot is changing, and gold really appears to know this, right? So since last year's conference, since this time last year, the US dollar gold price is up over $600 per ounce, or about $900 in Australian dollar terms. All right, so that's 30% over the past 12 months, and it's been doing that while defying really traditional relationships with US dollar foreign exchange rates, which generally dominate the value or the nominal price of gold in US dollars in the short term, and importantly also interest rates. We've seen a complete disconnect from the pattern or rate relationship that has dominated our understanding of gold and rates and monetary policy for the past 50 years. So the real question is, against this rapidly shifting framework, what are the risks and opportunities when we're looking at precious metals opportunities? So what I want to do is walk through some general background questions with the panel, and then we'll start digging into a little bit more specifically some of the questions or some of the ideas that they think about when they're choosing assets and also thinking about what to avoid. So first question that I have for the panel is to sort of set the stage. If we start by looking backwards, how have you seen gold historically, and how have you traditionally positioned yourself, right? So maybe we'll start with Brian again.
So gold has had a historical, like, I would say 6,000 years of history as money, but over time, especially in the last 70 years or so, starting from the Bretton Woods system in 1944, we gradually moved out of the gold standard and into a fiat currency standard, and we became fully fiat by 1971, almost 53 years ago. Now, in Australia, everyone sitting in this room, we're an over-representation of people who still recognize gold as money. Whereas, if you go out, if we walk out of Crown Towers, Barangaroo, and you're talking to people about investing in gold, they'll look at you funny and they go, you can't eat gold. But if you can always answer them back and say, and you eat plastic notes and 50-cent coins? That's a ridiculous answer, but that's the most popular response because society's been told to ignore gold and focus on property, stocks, bonds, and now also crypto. And whenever I say the word crypto in a gold conference, it's almost like swearing or uttering blasphemy. But I believe that there is a role for both, and I'm not here to debate any further on that, but just recognizing that it exists. With gold at the moment, I believe, if you just look at the price, as Alex pointed out, price has gone up 30% this year, and I believe it's gone up 100%, 120% since most of us bought our first barrel of gold if you bought it in the last 10 years. And that tells you something. Where else can you get an investment where you do very little and in the long term it goes up? Now, not financial advice, and it's really important to do your research on this, but the emerging role of gold in the future is competing against a larger range of assets, including digital assets. But gold remains, gold was, is, always will be the exact same thing.
And if I might ask, just to extend that, how have you traditionally made your investments in gold? Is it stock, specific? Do you buy mines? Do you buy securities? Do you buy gold itself, futures?
Good question, and I'll talk about that tomorrow as well. But briefly, gold is my base wealth, so hopefully my wife, my son, and I aren't going to be homeless because we do have some gold. Not telling you my address, just in case you guys try to go in there. I have a large proportion of my wealth in mining companies. It is much riskier than most people would accept, and I'll explain why tomorrow in my presentation. So that's where it largely is. Bullion, some gold and silver ETFs, largely gold stocks across producers, developers, and early stage explorers.
Thank you. Andrew, you work for a private investment group that has the luxury of being able to think very diversely and react very quickly to what it does and doesn't want to do. So, for being in the private market sector, how do you guys hone your approach to gold? Where do you allocate? How do you view it? What are your preferences there?
The interesting thing, and I certainly agree with all of your points there, Brian, but the one point I just did want to make is that gold doesn't yield anything, right? You don't, you buy a house and you can rent it out, you can get a yield. So while we see gold as a valuable component of any portfolio, and it should really be in every portfolio, you just got to be mindful that you're not going to get a return as it relates to a yield on that. Now, you're going to get an outright return, hopefully, if the gold price goes up, and I think there's not a person in this room who doesn't think that. Now, from us, we very high net worth family, and they can, to your point, act very quickly on and be a little bit more opportunistic. So from our point of view, where we get our exposure is generally in equities, and we do deals with certain mining companies where we might be able to take the offtake. So we'll take the physical gold, we'll give them a prepayment on any of their upcoming gold production. We'll take a bit of risk that they'll be able to deliver that gold, but then we take receipt of some meaningful quantities of gold, and then it's up to us whether we want to hold that for a period of time and see if we can get appreciation on the gold price. So we take a little bit of risk there, or else if we're walking down to ABC Bullion with spot right shopping bags and see if we can swap it out for some cash.
Thank you very much. So Richard, moving to you, you've got, you and Rob both have an interesting experience both building and then financing assets. So, I guess globally, how have you really approached gold and gold investment? Has that been something historically that's been just a metal opportunity, or is it something that you see as something that's got a broader connection that actually drives the investment premise?
I think in the time that I was in mining operations, you're talking to industry people all the time. Gold was exciting. I was in gold projects, and my investment style was completely non-strategic. Someone would point you to a good set of drill results, and you go and have a look, and you just buy gold equities based on the speculation and opportunity, and I guess the buzz. And so gold was always much more exciting than any other commodity back in the day, and probably still is. But back then, that was my sort of personal investment strategy, and it was just to sort of follow the trend, what I thought were good geologists with good companies talking up a good exploration story. Sometimes successful, mostly holding on to them too long, and not successful. As I moved into more patient sort of investing, and certainly using the bank's balance sheet at Macquarie, it was all about risk management, and then a deep due diligence dive into assets, and very much more cautious, downside risk protection. And it was a very different investment style, but that was again using someone else's money, not my own. I'm probably not really able to invest personally when you're looking in a bank at a whole range of investment opportunities. So during that phase, I guess I was just carefully deploying the bank's capital, and I'd like to think that we made some great investments and some great returns for that business. And then maybe moving into private equity. Again, slightly different investment style, much more about taking a controlling type investment. So maybe I'll leave that for Rob to perhaps elaborate on, but again, a different style. And I think over the time, and I guess you may ask this in a minute, but my personal investments have become much more discerning and much more strategic, rather than the early sort of unstrategic, sort of random approach, and that just comes with experience, I think.
Thank you. Yeah, and Rob, over to you. I mean, you guys have done some very specific, concentrated investments in gold over the past several years, and not just recently when it's become popular, but going back to lower gold prices, but some pretty interesting assets.
Yeah, we've been long and strong believers in gold really forever. So, and having seen both sides of the table in terms of being at a mining company, mining companies, CRA, Rio Tinto, and then Oxiana, Oz Minerals, seeing it from the public equities side of life, and then moving into the private equity. I mean, so just for context, for people that don't really know much about EMR Capital, we're a concentrated portfolio, mining only, and really asset managers as opposed to generalist investors. So we tend to want to own and operate assets. So a little bit segue from what Richard said, and I should say that agree wholeheartedly with what Brian said in terms of the thesis around gold. I mean, we're rusted on gold investors, so we just believe in the long-term fundamentals, and the fact that really gold is a prudent and compelling part of any portfolio. But really, it comes down to us being asset managers for this, and we can maybe flesh it out with more of the discussion. But the ability for us, we're a financial investor for a period of time, and so asset quality is important, and the ability to improve that asset. But and so you're right, we tend to take majority or outright ownership of assets and manage them for a period of time.
And just, I mean, I'll follow up on that with that sort of baseline of how you've done things historically. Against this context, what we see, are you guys, or any of you guys, sort of repositioning the way that you're seeing gold? Are you preparing for the world to see gold differently, or is it more of a responsive, let's see what the world does and then we will shift? How do you think about that, Rob?
Well, I certainly think that our view of gold is not going to change, I don't think. And I mean, it's always subject to discussion and so on, but I mean, gold is something that we're continuing to look at. It dominates the new investment opportunity pipeline that we're seeing right now, and I think, you know, we'll probably get there in a moment, but I mean, the disconnect between the gold price and sentiment is baffling in some respects, and so we see that as a great opportunity and an arbitrage to invest in gold, and think that will close over time. So we're certainly, I mean, it dominates the opportunities that we're looking at the moment, and you know, we can probably not, now's not the time, but I mean, the Aussie market, any of the Aussie guys will say, I'm feeling unloved, the share price is undervalued, and any good CEO would say that, as you'd know. But I mean, you compare this to Canada, for example, where the market is just an absolute train wreck. Now, sad for those guys, and I'm happy to sit around the bar and help them cry into their beer, but it's a great opportunity for us because they are finding it really difficult to fund their projects.
That's very helpful insight, and I guess, Richard, I'll actually just extend that question with you. So when we look at this circumstance of very, very high gold price, hitting records almost every month, and this essentially relatively very low trend in gold equities, you know, why do you think this is, and you know, is this a significant opportunity in your view as a professional investor?
Yeah, clearly it's you know, it's a fantastic opportunity for the same reasons Rob sort of alluded to. But I think, you know, we're seeing, you know, it's getting harder to permit and develop new mining projects, and gold projects always used to be have lower barriers to entry in terms of capital costs, capital intensity. So I think owning gold assets now that are producing or in development phase gives you massive leverage, because you know, you've done the hard yards, you've gone through all of that sort of, you know, it's 10 to 15 years now to get a new project up. So my appetite is increasing for gold, and particularly for those sort of brownfields expansions, and they're underpinned obviously by a sort of, you know, rising gold price. So I think the leverage that rising price creates, you know, is developing fantastic investment opportunities. And yeah, for some reason, you know, these assets do trade at ridiculous discounts. You know, a typical pre-development asset, you know, is 0.2 to 0.4 times NAV. That's what they trade at. You know, and I guess the market's saying there's a financing or an execution risk around developing these projects. But once you can get into production, then you know, the re-rate to something closer to NAV or NPV of the project is real, and that value is what we try and capture. And then you've got that massive upside leverage to, you know, resource growth as you advance the asset.
And Andrew, with the diversified approach that you guys take in your portfolio, when we see this big step up, when we see moves like this, does this influence the way that you are looking to take those positions? Are you guys pulling back and reallocating to certain strategies, or are you still maintaining a very sort of broad approach to things?
Look, we've taken a longer term view on gold from here. Where do we think gold's going to be in a year or in 3 and 5 years' time? And we've made a call on that, and we're increasing exposure. We need a lot more exposure. You know, just you know, thinking about why there might be a disconnect between the gold price and the underlying equities. You know, we're certainly mindful of, you know, during post-COVID, there was a high inflationary period, and all-in sustaining costs for a lot of these companies were increasing. And I just wonder if, you know, a lot of investors out there sort of left the gold space and never really got back in. And I'm also mindful of the interest rate. So to my earlier point, where gold doesn't yield anything, we were in an increasing interest rate environment. People were saying, okay, well, I've got some money. Can I put it into some fiat currency and get a return on that money? Or am I going to put it in a non-yielding asset, be it copper, gold, or whatever? So again, another reason why I think people maybe left the gold sector and haven't really got back in. But now we're in a situation where the gold price is ripping, and I think it'll rip further, and investors haven't really come back into gold, and herein lies the opportunity. So yeah, certainly we're looking at, you know, from a diversified portfolio, of course, as you know, looking at these as gold as a sector that we need to, you know, increase exposure to, and you know, we'll be looking to up to, you know, 15 to 20% of our portfolio based on our bullish view.
Thanks. And Brian, look, as an analyst, you speak to a lot of people. A lot of people in this audience are sort of your readers and followers. So, what is the feedback that you get when you speak to people in the market, and how do you see sort of the future opportunity and positioning today for that?
Well, so as I've got about 4,000 to 5,000 newsletter paid subscribers in the Australian Gold Report, which is the entry level how to build a diversified precious metals portfolio with physical gold and silver, ETFs, gold producers and established developers. And then there's also the premium newsletter, which is for speculating in explorers and early stage developers, including your company, Barton Gold Holdings, which is one of the outstanding companies among the portfolio we've recommended. And we have about 400 or 500 readers. And that's down from, in the peak in 2022, about 7,000 in the Australian Gold Report and about 1,000 in Gold Stock Pro. Now, part of that is, I will admit to it, mistakes that I made, I will own them. And of course, the sour taste that the rising price of gold didn't lead to gold stocks performing, and people then following lithium, rare earths, tech stocks, crypto. So that's the type of thing which happens. Now, how do I position myself and also my readers in this time is, gold's made record highs. Gold stocks are actually somewhat left behind. There's a significant valuation gap. And I can put some numbers to what Andrew was saying about the performance of gold stocks. The operating margin, as in the difference between how much they received on the selling the gold and how much it cost to produce, fell from about 42% in 2020 during the period when the world was locked down to about 29% at the bottom of the cycle last year in, I think, the June to September quarter. This June quarter 2024, the margin has gone back up to 42%. And yet, the ASX Gold Index is just sitting at about 8,400, 8,500 points, which is 1,000 points below the record highs in 2020 in August, 9,517 if I remember correctly. Now I look forward to, in this gold stock recovery, for the ASX Gold Index to go beyond that, but it is up to the producers to be able to push the cost back down from almost $2,000 all-in sustaining costs to maybe about 1,700, 1,800 average, as gold, let's say gold doesn't go up any further and it stays about 3,700. If you can push the cost down a bit, then the rest of the market's going to pile back in, because it is one of the most profitable commodities producers in the whole space, and also against itself historically. And I'm positioning on that. I'm positive because of the, as Damien has pointed out, inflation's going up. They haven't found they're going to cut rates, and that is going to lead to more interest into the industry. So rather than going, I'm scared about the gold stocks because they've been underperforming and gold's at record highs, I'm actually doubling down at the moment.
Brian just made a very interesting point, which I will highlight and then go into the next question. I'm sort of a big fan of the idea that knowledge comes from reading and wisdom comes from pain, right? Like, you learn from mistakes, right? And everybody on this panel is still gainfully employed, which means they've had a lot of successes, but they've also made a lot of mistakes. And these mistakes are where we sort of sharpen things up and improve for the next time. And sometimes there are things you just can't call right. Things shift, things happen, but it is really important to sort of get into digging a little bit deeper on how you actually choose assets and what do you avoid. So what I'd like to ask the panel to sort of give us a bit of an overview on is, when you get down into looking at specific assets, whether it's a project, company, portfolio of securities, what are you looking for when you're choosing your exposures? Is it driven by very specific metrics? Is it people? Is it the project metrics? Is it jurisdiction? And what are your red flags? What are the things that you really watch out for and try to dodge in the portfolio. And actually, we'll go back to Brian on this because we've had an interesting conversation around, in particular, sovereign risk or jurisdictional risk that can often be misinterpreted as continental or countrywide. But we've had some recent news out of the gold sector, which has been kind of a surprise for everybody around the McPhillamys project here in New South Wales. So Brian, I'll hand that one back to you.
Yeah, so I have been very numbers driven in the past, and I looked at the financial statements and the quarterly reports. But the iceberg for me, as I sail through this sea, is management and also jurisdictional risk. And Regis Resources and Silver Mines, so Bowdens and McPhillamys, they have been, so the New South Wales government or the federal government has stood in the way. Now, these two companies, I can't say it's a fault of specifically to them. A lot of people, if you read the Hot Copper Stock Forum posts, they're slamming management for this, and it's almost as if it's their fault. Whereas there's a lot of political, there's a lot of politics going on. And as much as Australia, Canada, and the US are sovereign, are the top class jurisdictions, we now have a new form of politics of environmentalism, of social justice, which affects the decision makers who are actually actually going through these applications and determining should these projects go through. And sometimes, it's economically sound, it's creating jobs, but something happens and the government goes, look, there's an interest group, there's a particular bunch of people who say no, and they have put a lot of pressure. The media's on top of this. We can't say yes, and we just have to shelve this project until later. And I think that's a significant risk nowadays, which I'm sure the panelists here who run companies as well are clearly very aware, and it's a new game, isn't it?
Andrew, you guys invest in everything from resources to energy infrastructure, right? So for you, what are targets and what are landmines?
Look, when we get down into the individual companies that we're looking at, every project will have its economics around it, and it's up to you as the analyst to try and work out what's going to be successful and what's not. So, to your point, Brian, obviously sovereign risk does come into it, but we have a very high appetite for risk. We're in Sierra Leone and Angola. We're happy to be anywhere as long as the project is right and the management is right. And I cannot stress the management part enough. It is the one deal breaker for us. We need that past performance from the management, and we need to be able to trust them with our funds. So looking at the individual projects, we're looking at obviously. These are easy things. You guys are going to know it already. It's grade, it's type of ore. Is it open pittable? Does it for us? Refractory ore will be a component that we look at as well. I'm not saying it doesn't work. Grade is usually higher with refractory ore bodies, and it usually compensates for that. But it adds to your operating costs, and it adds to your complexity. So we're mindful of refractory ore bodies. They tend to be deeper as well. So those are the obvious things that we would look at from an equity point of view.
And Richard, look, you've been management, you've financed management, and you've bought management. So that's obviously one that you know a lot about. So you can maybe speak to that. But also, are there any other really strong drivers for you?
I think in all investing, it's matching your investment time horizon with the life cycle of the project. Know where you want to be in that investment sort of period for your own capital, and then match it with where the project is. Obviously, everyone's probably familiar with the Lassonde curve, which shows the sort of the time value of companies as they go through exploration, peak value through the euphoria of growing a mineral resource, and then prices sort of value perception sort of drops as projects go through development phases, and then you try and sort of think, well, that's a good value time to invest, but that uncertainty in that sort of orphan zone that we call it is probably a graveyard for me in terms of investments, where you think I'm buying a good value, but I'm uncertain about ultimately when that asset's going to be developed and get that re-rating to come back up into production. If you're buying just producing assets, that's great, and looking for good management teams to work those assets harder, grow value, reduce cost, increase operating margins. I mean, that's a great sort of strategy, but I guess my sort of personal bad experiences have been all in that sort of pre-development zone where I think I'm buying well, and typically the assets are good value, are good assets, but the uncertainty, as I mentioned earlier, of that sort of permitting, competing land use issues, can be a massive drag on your investment returns. You're having to fund the business still all through that time. You're waiting for things to happen that are a little bit outside of your control, and investors kind of get frustrated and fed up, and so it's a difficult time. So red flags for me are just looking at projects early on. Well, yes, will this project, can it be a mine? Yes, so I'm happy to invest. What are the competing land use issues that are going to potentially slow down this project development timeline that are outside of my control? Is it going to be 3 years, 5 years, 10 years? And that's a real red flag.
And Rob, so a lot of your team at EMR have been on the Oxiana Oz EMR journey. So I imagine quite a bit of your actual historical doing experience shapes the investing premise now. So how do you guys look at things?
No, absolutely. And so I guess the context here is different to those days. EMR, we manage 10-year closed-end funds, so we really need to engineer an outcome. So invest the money, weave your magic, and then exit the investment all within a 10-year time frame. So that really is it's a very important lens or point about the lens through which we view an investment. And sort of expecting or anticipating the question, I went to the trouble of writing down what we call internally the rule of 9, and so we just have come up with this over sort of a period of time, I guess. And so when we go to an exco or investment committee meeting, these are the 9 criteria that I'll text them to you. These are the sort of questions we're going to get. Now, these are the broad categories. There are nuances about each, but I mean, just building on what the other guys have said. I mean, it's scale, grade, technical risk, and I had to write them down. I should remember them, but if my chairman saw this and I didn't remember them, that would be a career-limiting move. Low cost or cost profile, long life, upside, the ability to grow the resource, jurisdiction, the returns, and the ability to exit. So we can have the most fabulous project on the planet, but if for some reason, whether it's jurisdiction or something else, you can't exit that investment, then that is not a place you want to be. So they're the sort of criteria, and it really probably should be the rule of 10, because Andrew makes a great point, and that is your team and management. Absolutely critical. I mean, you live or die on their ability to execute. So the thesis for us is very much about, we've tended, because you're working with that time frame, we tend to work in a more brownfields environment. So own and operate an unloved or forgotten operating asset that is not as subject to greenfields permitting risk. And then what you've got to see is the opportunity to put the capital to work to improve the asset, whether that's resource growth, expand the plant, optimise it, whatever, and we've got some great examples where that's been successful. And then within that 10-year time frame, you have to have a better asset to be able to move on by exit through public markets, which we did with 29Metals, or just a trade sale. And I think one of the other key points about it is we're doing this as managing the asset privately, so we are not doing it as a public company, and so we're not reacting and having to live that experience within the volatility of a daily share price, which fluctuates. So we've got the ability, patient capital, to go away, execute on the plan, and hopefully within that sort of 5 to 10 year period have a much improved asset. And we go to, I guess, the examples from EMR. I mentioned Oxiana, where we financed a gold project in Laos, and people, I mean, in those days, people used to say, which part of Africa is Laos in? Anyway, I mean, that was just a reflection of, what are you doing in Laos? Then we've had a fabulous success in Indonesia, which is not everybody's cup of tea, but there's a good reason for that, and really just goes to our history from Rio Tinto days in Indonesia with the Matabi project, and now we own a 50% stake in the Ravenswood gold mine in Queensland. So different jurisdictions, but every one of those was the opportunity to take an asset, put money to work and improve it, and there was always a universe of buyers for those assets. Well, we're still to test that with Ravenswood, but we feel confident given what the asset quality is.
Thank you very much. The ability to sell, whether it's an asset or an equity, is very, very important. So liquidity matters, right? So look, thank you all very much for that. I thought what we might do with about 5 minutes that we have remaining is take 1 or 2 questions from the audience, if I can ask for a brave volunteer. We've got one here and a microphone coming up just behind you.